We all dream about making money without having to work, right? Yet we were told that this was not possible. We were told that making money requires hard work for a long period of time, and that we cannot be rich unless we inherited a fortune or won the lottery. Wrong. Making a passive income with a small effort is possible, and there are many ways to make it happen. You can invest in real estate properties, you can sell your courses or your ebooks online, or you can create a YouTube channel and earn ads revenue, and many other methods that we will teach you in this channel. That's why you should hit the subscribe button if you haven't already done that. Well, all these methods are great, but they are not totally passive. You still have to spend some time on them to keep them running smoothly. In this video, we will give you 3 priceless tips on how to make passive income from stock markets in the simplest possible way. So get ready. Tip number 1, invest your money as early as possible. Meet Samantha and Lauren. Samantha started investing at the age of 20. She invested $2,000 per year for 45 years in the stock markets. During these 45 years, she invested a total of $90,000. Meanwhile, Lauren started investing at the age of 30. She invested $4,000 per year, which is the double of the yearly amount invested by Samantha. Lauren invested her money for 35 years. The total amount invested by Lauren is $140,000. So Samantha started investing 10 years earlier than Lauren, and she put in a total of $50,000 less than her. To simplify, let's consider that the stock market grows steadily by 10% per year, which is a logical assumption because the average growth of the S&P 500 during the last 90 years is 9.8%. So when they retired at 65, Samantha was sitting on a nest egg of $1,581,590.64. And Lauren, who invested $50,000 more, ended up with $1,192,507.22. So there is almost $400,000 of difference between them, and that's crazy. So just because Samantha began investing 10 years earlier, she ended up making $400,000 more than Lauren, although she invested $50,000 less than Lauren. This shows the power of compound interest. The more you invest earlier, the more money you make in the long run. So what we recommend to you is to start investing as soon as you can. Instead of buying the latest iPhone, buy a cheaper smartphone and invest the savings. Saving $800 per year will not make you rich. However, investing $800 per year over 45 years will make you a good amount of money. Money that you earned while doing nearly zero effort. Now, you can argue that this is a good example, but investing stocks is very risky. And the 2008 economic crisis is a valid argument. People lost their money and houses. We understand your fear, and we will show you why you should not be afraid of investing in stocks, and how you can protect yourself from losing your money. If we Google the evolution of the S&P 500 index in the last 40 years, we can see that there are 2 major stock market crashes: the dot-com bubble in 2000 and the subprime mortgage crisis in 2007-2008. By analyzing this graph, we can see that even if you had invested at the very worst moment, meaning just before the crash, you could have recovered before 10 years. And that's the proof that the stock market is somehow safe if you play it long term. So what happens in a crisis is that everybody panics and becomes afraid of losing their money. They think that the price will continue to go down, so they sell with a loss, thinking that by selling now, they are avoiding a bigger loss. That's the nature of human being. An intelligent investor has a bigger faith in the economy and understands very well the economic cycles. That's why when he sees that everybody is selling and that the stock market is crashing, he does the complete opposite. He buys. A crash in stock market is a great opportunity to move up the ladder. And here comes tip number 2. Invest more money than you usually invest when a crash happens. When the masses are panicking and selling, do the opposite. One of the greatest investors of all time, Warren Buffett, said, "Be fearful when others are greedy, and greedy when others are fearful." Sir John Templeton, one of the best investors in the last century, said it a bit differently. The best opportunities come in times of maximum pessimism. So the best time to invest is to wait for a crash. But that doesn't mean that you should wait until a crash happens. You should start investing today in order to benefit from the power of compound interest. And when a crash happens, you have to invest more and more. By the way, if you are still watching this video, it means that you are interested in making passive income from the comfort of your own couch. That's why we prepared you an hour of free video course in which we will give you a lot of techniques to generate at least $2,000 per month while sleeping. Of course, it is not a get-rich-quick method. There is a lot of work to be done up front before enjoying the money falling into your bank account. All you have to do to watch this free video course is to click on the first link you find below in the description. Now let's get back to our topic, and let's see together the tip number 3. What stocks should we invest in? The main issue here is that we can never predict the future, and we can never foresee the success or the failure of any given company. Even the economic specialists who work day and night to analyze the market cannot predict with accuracy which companies are going to succeed and which ones are going to fail. A company that is leading a market right now could end up failing in 10 years. Let's take an example of Blockbuster company. Blockbuster was a provider of home movies and video game rental services. It had a huge success, and at its peak in 2004, it was employing more than 80,000 people all over the world. In September 2000, Blockbuster CEO John Antioco declined an offer to buy Netflix for $50 million. He didn't even bother to consider the opportunity. He could have become a multi-billionaire had he accepted to buy Netflix at that price. In 2010, Blockbuster went bankrupt because of the rise of online streaming companies like Netflix. John Antioco couldn't predict the future. He didn't see what was coming, nor will we be able to. So how do we know in which companies we should invest? We believe that diversification is key. That's why we recommend you to buy index funds. An index fund is a portfolio constructed to match or track the components of a financial market index, such as the S&P 500 index. The S&P 500 index fund includes the largest American companies listed on the New York Stock Exchange, or NASDAQ. It includes companies like Apple, Google, Facebook, Coca-Cola, and Amazon. When you buy an index fund, you are betting on the economy and not on one company. So if one company went bankrupt, there are 499 other companies, and some of them might be performing well enough to protect you from losing your money. So all you have to do is buy the S&P 500 index fund and keep holding it for a long time. Let's take an example of someone who invested $10,000 in January 2003 and held them until January 2019. His $10,000 transformed into almost $40,000, so he made $30,000 without any single effort. Note that if the 2007-2008 subprime mortgage crisis did not happen, he could have multiplied his investment by much more. So instead of buying a $30,000 car to show off in front of your friends, think about buying a $15,000 car and invest the rest in the stock market. You would be surprised of the amount of money that you can spare to invest in stocks when you put your mind into it. Think about all the money you spend on unnecessary things like your daily morning coffee from Starbucks, or your new watch, or your expensive pair of shoes that you wear one time per year. Save all the money that you spend on these things and invest it. If you want to learn more tricks about how you can master your personal finances and make your money work for you without losing time analyzing stocks and learning the latest trade techniques, we recommend you read Tony Robbins' book, Unshakeable. You'll find a link to this book on Amazon in the description. In this book, you'll find plenty of tips that will help you transform your financial life and accelerate your path to financial freedom. But you should note that in this book, the author will constantly try to market and sell other programs that he has in his sales funnel. If you're not okay with advertisement, then this book is not for you. That's it for this video. If you enjoyed it, don't forget to share it with your friends and hit the like button. And if you want to get more tips on how to make intelligent financial decisions, all you have to do is to subscribe to this channel, because we will teach you how to invest wisely and how to master your personal finance, how to build a business from the comfort of your own sofa and make a six-figure sum, and how to take your business to the next level if you already have one. So don't hesitate to subscribe and hit the notification bell to stay up to date with our latest videos. By the way, if you are still here while the music is running, here are 2 videos that you'll love watching. Just click on either one of them on the screen right here.